Good morning, everyone. My name is John D'Antona, and I'm the Director of Marketing here at CAPIS. Welcome to our July monthly research briefing. CAPIS would like to thank everyone for taking the time out of their busy day to spend with us. We hope that you find the following information in today's briefing useful. Also, know that CAPIS records and saves these research briefings on our YouTube channel for future viewing. So in case you missed something or would like to review a portion or all of this broadcast, please visit the CAPIS YouTube channel and select CAPIS Research Briefings. There's a lot of content there, so feel free to give it a browse. You can also read a brief recap of the briefing's topics on our website, www.capis.com. Click on the News tab and select Insights. We usually have something posted within 24 hours. Now, before we get started, as always, the legalese. The opinions expressed by the featured speakers do not necessarily reflect the views of Capital Institutional Services, CAPIS, or any CAPIS ownership, or any CAPIS management not providing said opinions. Any comments and or information presented within this presentation are for the sole use of investors. Nothing in this presentation should be construed as an offer, invitation, or recommendation to sell, or solicitation of an offer to buy any securities that might be mentioned. And now I'd like to get over to JC Parets, but before I do, please note that JC will take questions at the conclusion of his remarks. Kindly type them into the Q&A portion of your Zoom and we'll be sure to get to them. And now on with the call. JC Parets, CMT, is founder of AllStarCharts, a technical analysis publication for hedge funds, mutual funds, financial advisors, family offices, and other investors. He is an 18-plus-year veteran of Wall Street with experience in equities research, money management, and technical analysis. In 2012, Parets founded Eagle Bay Capital with the goal of managing money through one portfolio in a limited partnership. He has also launched AllStarCharts research platform, All-Star Options, and AllStarCharts EDU. Since the start of AllStarCharts, JC has been featured regularly on Bloomberg, ABC, The Wall Street Journal, CNBC, Fox Business, Yahoo Finance, Barron's, and other media outlets. We welcome him to the CAPIS family. JC, welcome.
Oh, thanks for having me, John. Appreciate it. Ready to rock and roll?
Yes, we are. So go right ahead.
All right, let's do it. See, we got this ready to go. You see the screen? We're all set?
We are all set. I can see you.
All right, sweet. Thank you for that wonderful introduction. Reminding me, I've been doing this now for 18 years, which is crazy to think about. I guess full-time professionally for 18 years, so I guess, been doing it for a little over 20 years total. Man, time flies. I'll tell you that much. But it has given me the opportunity to trade actively, manage assets through multiple cycles, many different environments, all sorts of different asset classes and leadership regimes, whether it be commodities more recently, bonds and other markets, stocks and others, cryptocurrencies, and really anything that's liquid. We can apply our technical tools and strategies to analyze supply and demand behavior, and that's really what we do. So we cater to investors of all kinds, right? From the largest institutions in the world, hedge funds, household names that you're very familiar with, and most major banks that you've ever heard of. We do business with a lot of financial advisors, hedge fund traders, and then the portfolio managers too, all sorts of stuff. So what's really cool is that I've been able to learn from them over many, many years, and not just in the United States, but around the world. I've given presentations in Singapore and Hong Kong and India a whole bunch of times, Mumbai and Delhi, Malaysia, Taiwan, Philippines, all throughout Europe, London, obviously, Athens, Dublin, Amsterdam, Paris, a lot of fun. And then obviously throughout North America, Toronto, Vancouver, New York, Miami, Dallas, Houston, Austin, San Francisco, LA, San Diego, the usual suspects, Chicago, all of the areas where there are financial hubs. Over the years, I found my way there. And then for me to stand up and give a presentation, talk about the charts that I'm talking about anyway, kind of like I'm doing today, that's the easy part. For me, where I'm winning is in the beers afterwards, in dinner afterwards, in lunches beforehand or the next morning. That's really where I win. And the one thing that I've learned over the years is that no matter how much assets under management a PM has, no matter how much experience a PM has, no matter where in the world a portfolio manager lives, we're all the same. We're all human. It's all between the ears. And that's why when you see patterns in the market today, you see those patterns back in the 1920s, the 1930s, the 1940s. Patterns you see in the stock market back 100 years ago, you see in the crypto markets today. Why? Because the asset classes might change. The market might be evolving, right? We're no longer in fractionals, the decimalization of stock prices, things like that. All of these things have evolved. But you and I, we remain exactly the same. So that's the ARB, and that's what we're trying to take advantage of. Now, obviously, nothing we talk about here should be construed as any sort of solicitation. These are not buy or sell recommendations. This is strictly for informational purposes alone, obviously. You can go to allstarcharts.com/terms. Check it all out there. Listen, we pay our attorneys a ton of money to write this stuff. Somebody might as well read it. Go give it a read. Let me know what you think. So when we approach the market, the first thing that we want to do is identify what type of market environment are we in, right? There are all kinds of different market environments: bull markets, bear markets, sideways markets, inflation, deflation, stagflation, disinflation. Everyone's got inflation. So the first thing we want to do is identify what type of market environment we're in, and then pick and choose which tools and strategies are best served for that type of environment. One thing that I've learned over the years, learned that the hard way myself, now I observe others making these mistakes, is that they think that they are a specific type of investor. I am a growth investor, JC. Oh, I only invest in US stocks, JC. Oh, only crypto, JC. Oh, I only sell covered calls. I only buy calls. I trade breakouts. I trade growth stocks. There's a time and a place for everything. And the idea is, rather than picking a strategy and always forcing that strategy upon the market, regardless of the type of environment we're in, is foolish, right? It's foolish. If you haven't blown up yet, you will, I promise. And those of you maybe laughing out there have probably done that, blown up, made that mistake and moved on and learned, right? I learned that lesson a long time ago. The first thing we want to do is not figure out our strategy and apply that to the market. No. That's foolish. First thing we want to do is identify what type of market environment are we in. And then we'll pick what tools and strategies are best for that environment. So, all right, JC, great. What environment are we in? Well, we're going on 34 consecutive weeks where more stocks made new lows than new highs. 34 consecutive weeks. Does that sound like a bull market to you? So people are like, by the way, this isn't anything new. It's been going on for 34 weeks. So when we were in the 20s, we were saying it too. And people are like, well, JC, it's not a bear market because the S&P is not down 20%. Like, what kind of serial killer thinks like that? Have more stocks been going down for a while, or have more stocks been going up for a while? The market peaked in February of 2021, my friends. That is 17 months ago. That is when the new highs list peaked on the Nasdaq. That's when the advanced decline line peaked on the Nasdaq. That is when all the ARK funds peaked. That's when Chinese internet peaked, biotechnology, the IPO index, all of that stuff peaked. Remember, everybody had a SPAC? I wanted a SPAC. I made not full disclosure. I made a couple of calls. I'm like, hey, how do I get a SPAC? Is this, that was February 2021. It's been a slow grind lower ever since. If you think that the last 15, 17 months are a bull market, I think you need therapy. I think you need to check yourself into a mental institution, right? What we've seen in the last year and a quarter or so, or more, is a relentless bear market in equities, not just in the United States, but around the world. So great, JC. So one mistake that I'm seeing people is like, oh, we just entered into a bear market. Or some people are asking me if we're going to go into a bear market. It's like, whoa, what do you call this? We've been in one for a long time. And that's important to recognize because bear markets take time. So if you think we're 2 months into this, you think that this is a new bear market, but we're actually in month 18 of this. We're almost a year and a half into this bear market. So it's long in the tooth, so to speak, right? Needless to say, what's going to get us out of this? What changes? Well, in a bull market, by definition, you have more stocks making new highs than making new lows. That's just what happens in bull markets. We've been seeing the exact opposite of that. So if you're looking to see what we should be looking for to identify, hey, perhaps we're no longer in a bear market, more stocks going up than going down is probably, a good place to start, right? So when you start seeing the new 52-week highs list do anything, there's probably a good sign. We identify the environment. Then we want to talk about what catalysts are going to either continue to drive these trends or reverse these trends. And this is it. This is it. And I don't want to be like Mr. Macro guy in a stock market conversation, you know, but I'm going to be that guy, right? You want me to sugarcoat it, or you want me to tell it like it is, right? We can talk about the Fed. We can talk about the recession, the war. I mean, if you want like bedtime stories, go turn on the TV. That's not where you're going to come and get from me. You're going to get the reality of the matter. The reality of the matter is war or no war, Fed or no Fed. Bottom line is there's a historically high negative correlation between the United States dollar and stocks. The dollar is the safe haven. It wasn't bonds, right? How did bonds do when stocks were getting crushed in the first half of this year? Bonds had their worst year since 1842, or their first starts of the year since 1842. I don't even know they had bonds in 1842. I guess they did. I guess that's not true. Have you seen like the interest rate chart that goes back to like before Christ? So I guess I did know there were bonds by 1842, but I hadn't really thought about it. The bottom line is worst starts of the bond market since 1842, long time. While the stock market was getting crushed, right? Worst start to the S&P 500 since like 1950 or something like that. So did bonds serve as a safe haven? No, obviously. So bonds are not a safe haven. At least they're not in this cycle. They were in the past. What about the Japanese yen? Was a safe haven, was a great safe haven. I remember I was managing a hedge fund in 2013, and the Associated Press, the Twitter account, got hacked by somebody, and they put that like there was like a bomb in the White House and Obama was in it. It was like a whole thing. And immediately S&Ps just fell 100 handles or something like that. Just immediately on that news, S&Ps fell. When you go back in 2013 when that happened, go back and look and see what the yen did, what gold did, what bonds did, and what the S&P did. And you'll see that the biggest safe haven of all of them at that moment was yen, Japanese yen. The Japanese yen is the Japanese yen is at the lowest levels since I was in college, right? That was a long time ago. It's a long time ago. I can't think of any other safe haven that we've seen. You can argue staples on a relative basis, not absolute, but relative, healthcare on a relative basis, and utilities on a relative basis, right? The areas that you would think would show relative leadership in a bear market are showing leadership, right? But I wouldn't argue those are safe havens because it's only on a relative basis. Gold's making new 2-year lows, so gold obviously is not a safe haven, at least not in this cycle, or in a lot of other cycles for that matter, but that's another conversation. The bottom line is it's the dollar. The dollar peaked right after the Trump election. How did stocks do after the Trump election? It's one of the greatest years in history. It was one of the least volatile years in the history of the stock market. How's the dollar doing in that environment? It was getting slaughtered. Then a funny thing happened in early 2018. By the way, cryptocurrencies also ripping in 2017. Remember, in Thanksgiving, like your drunk uncle asking you how to buy Bitcoin, right? Remember that? That was the peak, right? Dollar was getting slammed. Dollar bottoms in early 2018. Stocks and crypto peak. Not a coincidence. Dollar rips. Stocks and crypto were struggling until March of 2020, right? Dollar peaked. Stock market bottomed. Dollar got smoked for the rest of 2020 into 2021. How did the stock market do? Well, as the dollar got smoked, the S&P 500 had, I think, its greatest 52-week period ever, or like since like 1923 or something like that. The bottom line is one of the greatest years of all time as the dollar was getting slammed. And then in the spring of last year, as the stock market was peaking, right? Internals, the market of stocks, the dollar was bottoming. And the dollar has ripped higher. And how have stocks done? Stocks have done terrible. So I'm not going to tell you fairy tales about gold being an inflation hedge. I think the market has proven that that is nonsense. It's hilarious. The yen and bonds certainly not acting as safe havens. It's the dollar. So what is the catalyst to get us out of a bear market? The dollar's got to stop going up. The dollar's going to stop going up. It's the bottom line. Euro needs to stop crashing. Yen needs to stop crashing. Emerging market currencies need to stop crashing. That's it. That's all it is. Look at that breakout, right? Look at spring 2021. That's when the market peaked, right? And then look, right? Spring 2021, that's when the New York Stock Exchange new highs list peaked. And it's just been a deterioration ever since. The average stock in the New York Stock Exchange is down 36%. The average stock in the Nasdaq's down 40-something%, right? And then look what's happened since last week, right? This is as of Monday morning, but this persists. As you can see, the dollar peaked last Thursday morning, S&P bottomed and ripped ever since. What happened? Ethereum's up like 50% more. Dow's up like 1,600 points more, maybe almost 2,000 points now, right? Home run. Now, does that, just because we've had an initial rally on that dollar week, and just to show you, just a little bit of dollar weakness, a week of dollar weak, less than a week of dollar weakness. And like the market's exploding, right? Breath thrusts everywhere, you know, Ethereum ripping, all these altcoins ripping, Nasdaq ripping, you know, ARK funds hitting multi-month highs. All it took was a little tiny bit of dollar weakness, right? So imagine if we get a lot of dollar weakness. Okay, so what's it going to take to get us out of this mess? Well, you need a week to go by where you're not seeing more stocks making new lows and new highs, right? At least 1 week, right? You know, there's an old, you know, I don't know if it's like physics or something, but stocks need to stop going down before they can start going up, right? Sounds like common sense, but you'd be surprised. Probably not surprised. Most people just completely ignore that. Got to stop going down before you can go up. And you have a nice topping pattern in the S&P 500. We're below overhead supply. So as long as we're below 4,200, right now we are at 3950. We got to get above 4,200 and hold above there. Got to see it. In the meantime, the market is a downtrend or sideways, not an uptrend. Downtrend or sideways, as long as we're below 42 in the S&P 500. You can see that here, right? Just a nice little distribution. Call it a head and shoulders top, rounding top, whatever you want to call it. That's the least of it. It's distribution is what you're seeing, and we're below overhead supply. So that any strength there is going to be sold to you. So demand needs to prove that it can absorb all of that overhead supply to move on. Dow Jones Industrial Average and Dow Transports finding support at key levels, right? Finding support at key levels have held for 6 weeks. Held for 6 weeks. The Nasdaq finding support, technology. Freudian slip there because there's so much tech in the Nasdaq. Former resistance turning into support in the Nasdaq. If those lows hold, there's your trade. There's your mean reversion trade. So we've been in the camp that we are in an environment where mean reversion is probably our best approach, or not probably, like that's the approach we're taking, or that we've been taking. It doesn't mean we're in a new bull market. But you guys who have been around for a while know this. The strongest and biggest rallies in market history come in bear markets. My good friend Jeff Hirsch, he's the author of the Stock Trader's Almanac. If you don't get a copy of that every year, I can't take you seriously as an investor. Get a copy of the Stock Trader's Almanac. Tell Jeff Hirsch JC sent you. Tell him that I said that he needs to give you a discount and that he owes me beers. Jeff Hirsch, Stock Trader's Almanac. Go to the back of the Almanac and they have like just fun lists, like best days in the history of the Dow, best weeks in the history of the Dow, best days in the history of the Nasdaq, right? You have like the top 10 lists. You know what you'll find? The best days in all of those indexes in history are in the worst markets of all time. You're going to see 1929, 1933, 1987, 2000, 2008, right? Those are the dates that you're going to find. Not on the worst days, you'll find those dates too, but on the best days ever come in those environments. And when you identify, hey, what type of market environment we're in, we know it's not a bull market, right? If you have any common sense at all. So what do we know about bear markets? We know that we get the biggest rallies of all time. So if we have key pivot points, which the market has provided us, we have a trade, but that's all it is. So it gets back to understanding, what is your time horizon? When are you trying to make money? Today, like in the next 10 minutes? Are you trying to make money in the next few weeks, few months, few years, decades? Who are you? Why are you here? What is your time horizon? Me personally, I'm trying to make money in the coming weeks and months. That's me. In my opinion, that is where investors have the best edge. Because as a day trader, who the hell knows? I'll make the worst day trader ever. Terrible. And to be a long-term investor, I don't know what's going to happen next year. I don't know what I'm having for dinner tonight, yet alone what's going to happen next year. So I think that weeks and months period, trying to make money this quarter, I think that's the sweet spot. And you might argue with me. I've had these arguments plenty. We can still be friends. I am confident, at least for me, and I'm the only one that matters here because it's my strategy, it's my portfolio. You decide what's best for you. And we can argue back and forth about what the best time horizon is, and it's all good. I think it's looking out weeks and months. I think that's the arb. So that's me. That's me for sure. I like to make my life easy, not complicated. You know, I got a 2-year-old daughter and I got twin boys on the way. Do I need more complication in my life? I'm thinking no. Keep it simple, stupid, right? So here's your global 100 index, testing key levels. And the reason I showed you the Dow Jones Industrial Average, transports, the technology, which represents a quarter of the entire S&P 500, the S&P Global 100, to show you this is not just an American thing, it's global. They're testing key levels. Now I'm going to show you a list of stocks that are testing the levels, the levels. This is financials. You know what this $30 level represents? Represents the 2018 highs, also represents the pre-COVID highs. You know what it also represents? It represents the 2007 highs. So that means that financials today are where they were at the top before the great financial crisis. I don't know why nobody's talking about this. Like, do you not think that this is a big deal? The great financial crisis, kind of a big deal. Led by financials, right? Bear Stearns gone, Lehman Brothers gone, Merrill Lynch gone, Wachovia. Who else? You know, what was that? The guy with the tan? What was the Countrywide, right? The guy with the tan. Countrywide, gone. You know where we are today? We are at the peak of that market cycle before everything came crashing down. You know what else we are? Let me just show you where else we are. We are at the peak, my friends, of the last cycle in crypto as well. This is late 2017. This is Thanksgiving, holidays, Hanukkah, Christmas, all those things, Kwanzaa, all those things. All the families are getting together. And everyone's drunk uncle is asking them how to buy Bitcoin. Don't front like you don't remember that. Don't front. I remember that well. Remember it well. And then the dollar bottomed and the dollar ripped. And what happened to all these things? They got crushed. So not only are financials back to the peak before the great financial crisis, cryptocurrencies are back to the peak of the last cycle. By the way, if you're interested in these slides, you can email info@allstarcharts.com. Happy to send them to you. Make sure to use the password new bull market. I give a lot of presentations around the world and everything like that. So if you don't put the password, you're going to get some Malaysian palm oil futures presentation that I gave in Kuala Lumpur or something like that. New bull market. Make sure to use the password so you get the right deck. Info@allstarcharts.com, password new bull market, and I'll go ahead and send you the deck. No problem at all. Look at Europe. Look at Europe. Europe's where we were when I was in high school. Crazy, right? Europe has made no progress. So here we're looking at the Euro Stock 600, which is a broad measure of European equities. I look at the Europe Stock 600 the same way as I look at the S&P 1500, because this index includes small caps, mid caps, large caps. It's a broad measure in the same way that the S&P 1500 is for the United States. Retesting those former levels. Here's the 2000 peak, dot-com bubble peak, crash. Here's your great financial crisis peak, crash. 2015 peak, not crash as hard, but hit hard. 2018 highs when everything peaked, sold off. COVID, sold off. Whoops, sold off, and now here we are again. Back to the scene of the crime. Does former resistance turn into support, my friends? That is the question. That is the question. Because if it doesn't, and we lose those 2018 highs like we did in the All Country World Index, ex-US, and we did in developed markets, ex-North America, look what happened when we lost those former highs. Came tumbling down. Now, do we find support in these areas? We could. But that doesn't change the fact that we're below all this overhead supply, right? Like the S&P 500. With the US 10-year yield ripping, other areas did not confirm that. Regional banks were nowhere to be found. No confirmation at all from regional banks. None at all. Where did the 30-year stop going up? When everyone's like, oh my God, mortgages, you know, kind of. Stopped going up the same place, stopped going up in the fourth quarter of 2018. Where did the 10-year yield stop going up? Same place stopped going up in 2018. The efficient market hypotheses monkeys will tell you that that is just a coincidence. Oh yeah, that's just coincidence, JC. All right, maybe. Look at the value line index relative to US Treasury bonds. Where did it stop going up? So this is the value line. This is the median stock in the market relative to US Treasury bonds. Stopped going up, same place, stopped going up in 2018. Same place, the US 10-year yield stopped going up. The efficient market monkeys will tell you that's just a coincidence. It's just coincidence, JC. All right. Inflation expectations peaked in April. Here's inflation-protected treasuries relative to nominal yielding treasuries, putting in a lower high with the US 10-year yield putting in a higher high. Bond market was already telling you something was up. Commodities were making new highs as well, or the CRB index, I should say, making new highs as inflation expectations were putting in lower highs, right? So the CRB index led by energy was following rates. Everything else was telling you a completely different story. Look at the 10-year break-evens, already peaked. Here's an equally weighted index of commodities, not the CRB index, which is led by energy, but this is 33 commodity futures equally weighted, also peaked in April, with break-evens and inflation expectations, which are the break-evens, of course, as 10-year yield continued to make new highs. Regional banks were calling BS. Equally weighted commodities were calling BS. Break-evens, 5-year break-evens, 10-year break-evens, all calling BS. And now rates are struggling. The intermarket relationships had already told you that they were struggling. One fun thing I like to do is I like to look at the latest ETF launches, right? It's always fun because it's like a magazine cover indicator. By the time these ETF providers realize that there's any kind of demand for this product, by the time that actually launches, it's a little late. So what are we seeing? Latest launches, inflation protected ETF, iShares inflation hedged US aggregate bond fund, iShares interest rate hedged US aggregate bond fund, iShares inflation hedged. You think the ETF providers think inflation's here? Bond market doesn't. Commodities don't either. Neither do regional banks. How about the closes, right? The closes. Global climate change ETF closing down, a couple of them actually, which is hilarious. Short oil and gas, short basic materials. Nobody wants those anymore either after oil and basic materials ripped and all these climate change stocks got crushed. Hilarious. I don't know if you know this, but I think it's probably good for as an investor to know this. The in black, we have the Nasdaq versus the S&P. In blue, we've got large cap growth versus value. They look the same. The efficient market monkeys will tell you that this is just a coincidence, JC. This is voodoo. All right. With that double top in these ratios, because the bottom line is in the NASDAQ, you got a lot more growth. You have no financials, no energy, no materials, almost no industrials, no real estate. And in the S&P, you got a lot of financials, industrials, a lot of these cyclical areas, which is why the growth value looks like Hughes S&Ps. But notice that the bonds put in lower highs, right? Because there's a very high correlation between growth and value and interest rates, right? So as bonds are putting in a lower high, they were already telling you that this was a double top, right? So if bonds stop crashing, can we see some outperformance and growth in the NASDAQ? I think the answer is yes. Why do I think that? Because when bonds stopped crashing, growth started outperforming value. I got one more chart for you, John. One more chart for you. This is bonds continue to make new lows into June. The NASDAQ had already started outperforming the S&P 500. And if you think that Bitcoin's an inflation hedge, you are really bad at math. Terrible. Bitcoin and the NASDAQ move tick for tick. The correlations have never been higher. 10-day rolling, 30-day, 90-day. Never been higher. Never been higher. So if ARC breaks out above 47, I'm in. And I got some more charts, but we can go ahead and take questions, John, and we could bounce around on the charts, talk about whatever you want. How's that?
That's good, JC. Listen, that was some kind of, I don't know if whether to say presentation or performance there, but you're definitely one of the more lively characters that we've had on this thing. And I welcome that. I don't have any questions yet in the queue. But I did want to just, like I said, leave it to you. That ETF the slides you just had were really interesting in that what you're really saying is that the ETFs that are coming out, inflation protected or inflation hedge, they're all behind the curve then, really. If I have my notes here right correctly, you're talking about inflation peaked, according to what you're watching in April, the CRB commodities index, bond yields and everything. So these guys are 3 months behind the curve. Why would anybody want to buy these? But yet,
yeah, because I look at these guys in the same way as I do journalists and like the magazine cover indicator. Think about it like this. Journalists do a really, really good job of figuring out what investors are thinking, what consumers are thinking, right? By the time that they're able to figure that out, it's probably not early in the cycle, right? Number one. Number two, then they have to get approval for a cover story, write the cover story. Then they got to go to art, get the art approved. By the time the magazine actually comes out, it's very late in the cycle. The Economist magazine, for example, is notorious. My favorite of all of them. By the time you see it on the cover of The Economist, probably time to take the other side, simply because it takes so long to get there, right? The ETF companies are very similar. It's like the same data from different parties. What are the ETF companies in the business of doing? They're not in the business of helping you make money. They're in the business of providing vehicles for you to invest in. And they're only going to create these vehicles if there's demand for them. And if there's no demand for them, they're going to delist it, right? Like the short oil and gas ETF. I guess nobody wants that, so they delisted it, right? The short materials ETF. Like after oil and gas and materials rip, nobody wants those short ETFs anymore, so they're delisting. Hilarious. But it's the same thing as a journalist. By the time, you know how complicated it is to launch an ETF? You got to build it and the strategy and approval and this and the other thing. By the time it actually launches, it's probably late in the cycle in the same way that those magazine covers. So that's how I look at it. Like these ETF companies are not bad people. Like they're great. I'm friends with a million of these ETF guys. They're always buying me drinks and dinner. So love you guys. Keep it coming. And then, the journalists, like I've been doing TV forever, and Barron's and Wall Street Journal. I got nothing but love for the journalists. But what I'm saying is that they're very good at what they do, at aggregating what consumers are thinking. But the truth is, by the time consumers are thinking that, by the time the journalists come to that conclusion, by the time the art gets, approved and all that stuff, it's probably time to take the other side of that trend. Right?
No, you're right there.
Again and again and again.
Yeah, you're right there. As a former journalist, I do know about the creation of cover stories and artwork and all that. So I say it. We did get a question from someone here saying, JC, you gave us a lot of information, a lot of food for thought, but could you sum it all up in a sentence or two? Where do you think equities, fixed income? I mean, I think commodities is pretty easy where you think they're going, but if you could give this question, this person that's asking the question, maybe one or two sentences, where do you think we're and use your timeline, weeks, month, if you will. You don't have to go long term out there.
Yep. So I think that now remember, when we talk about the stock market, we talk about like S&P futures and what the Dow do today and all that stuff, which is fine. But let's not forget that this is a market of stocks, right? That's what we call market breadth. But there are 500 stocks in the S&P 500, or like 504 or something like that, right? The Russell 3000 has 3,000 stocks. The Nasdaq 100 has 100 stocks. This is a market of stocks. So I think it's important to understand that. And if the majority of stocks are going down, like the average stock in the Nasdaq is down 40%. Over 70% of Nasdaq stocks are down 20%, right? Like this has been a bear market. So to summarize what I think is going to happen moving forward, I think that we are still in a bear market. We don't have any evidence whatsoever that suggests we are out of it. We are in the camp that this is a counter trend rally. This is a mean reversion. I didn't even get into sentiment. I can show you real quick how sentiment looks. We are at here's the average bull bear spread. So we take the American Association of Individual Investors, and we take investor intelligence advisory polls, and we put them together. So we're getting the advisories and we're getting the individuals, putting them together and putting the spread between the amount of bulls and bears. The market hasn't been this bearish since 2008, right? So the rubber band is very stretched. This is all part of identifying what type of market environment we're in. So currently, over the last 4-6 weeks, we have not been wanting to short stocks, with few exceptions. There's been some opportunities, but for the most part, we've been approaching the market from the long side, looking for relative strength, looking for areas to be long, particularly in growth and crypto for that matter, with the catalyst being a weaker dollar. And just in the last week, we've seen the weaker dollar. So we've seen a lot of stocks stop going down, but we haven't seen more stocks start going up. And you need more stocks to start going up. And that's what we're looking at here. So you're not just going to see stocks showing up on the new 52-week highs list. Like it doesn't work that way. Breadth improvement is a process. Stocks need to start showing up on the 20-day high list, on the 63-day high list, right? It's baby steps, right? Walk, crawl, run, right? It works that way in market breadth as well. You're not just going to see a ripper in the 52-week highs list overnight. It's going to happen. It's going to be a progress. So step one, we need to see the new 20-day highs list, right? And we don't consider it a breadth thrust. Right now, we're like 40% of S&P stocks are hitting 20-day highs. We want to see that above 55. That would be a major breadth thrust, in my opinion. We've had a couple of 9-to-1 volume days showing breadth thrust. And what do we know about these momentum breadth thrusts? We know that they cluster together early in bull markets, early in bull market cycles. So now that everyone's convinced that we're in a bear market and a recession's coming, time to look for that rally. Right? So I'm not convinced that this is anything more than a bear market rally. It could very well be, but it would be irresponsible of me to say this is a new bull market for the next couple of years in stocks and crypto. It would be irresponsible for me to say that because we don't have the evidence to suggest that yet. What we do have is enough evidence over the last month or so to suggest that trading this market from the long side, from any sort of intermediate term perspective, which I consider weeks and months out, is the prudent thing to do, particularly in areas that have already been basing for quite some time. The ARK funds bottomed in May. Chinese internet bottomed in March. The new 52-week lows list on the Nasdaq peaked in January. So we've already been seeing breadth improvement underneath the surface, which supports a long bias from an intermediate term perspective, understanding that in the future, maybe later this quarter, maybe in the fourth quarter, maybe tomorrow, we get enough evidence to suggest that this has legs. Like, and I'm going to give you a great example. In 2015, I was Mr. Gloom and Doom. I thought the world was coming to an end. Deutsche Bank's going to zero. I was that guy, right? And then we got the crash into January of 2016, bounced, successfully retested that in February in the S&P, Europe, Japan. And there was relative strength in January in base metals, Latin America, emerging markets. And we got a ripper into the spring. And as bearish as I was in 2015, we were very long going into, in February, going into the second quarter, and our upside objectives were hit in April and May. At the time, I was convinced it was a great, sweet trade. Now we can short everything again, right? That was my thought process. And then what happened? We kind of churned around into June. At the end of June, I went to Mexico. I went to Cabo San Lucas, drank a lot of tequila, had a great time, too much sun, the whole thing. I came back to my desk after July 4th weekend, started ripping through charts. Remember, I went to Mexico bearish still, thinking we were going to roll over, waiting for my short opportunities. And I'm like, I'll short everything when I get back from Mexico. All right. I got back from Mexico. I started looking through charts. I'm like, oh my God, we need to buy everything, right? And why did I change my mind? Because the data supported buying everything, not shorting everything like I thought we were going to do in January and February when we were getting long stocks for a mean reversion. So just like now we've been getting long stocks for a mean reversion, we could very well later this year get similar data to what we did in the summer of 2016 that suggests it's not just a mean reversion, JC, this thing's got legs, right? I can't tell you that yet because we don't have that data yet, but I'm certainly open-minded to it.
Okay. And we have another question that just came in here. What are a couple of the evidence pieces that you look for to determine if it's a bull market?
Well, the opposite of this, for one, right? In bull markets, you see the opposite of this. We're on 34 straight weeks with more stocks making new lows and new highs. Is that something you see in a bull market? Obviously not, right? Because if you think that's what you see in a bull market, you're going to be working here, right? That's no good, right? 34 straight weeks. So what is one of the things that I'm looking for to determine that this is a bull market? The opposite of this, right? For one, so that's evidence that we're not in a bear market anymore. What's going to be the driver? What's going to be the catalyst to send stocks higher? It's this green line down here not going up. And we do have a little bit of a divergence because we got new highs last week and we did not get new lows in the New York Stock Exchange Composite or a lot of other indexes for that matter. So a little bit of a bullish divergence there for equities, which further supports perhaps being long is the right side of the trade. And by the way, the market has been confirming that, right? Because the dollar peaked last Thursday and the market has had a hell of a week with the dollar getting smoked. And the dollar hasn't really even gotten smoked. It's just not up and down a little bit, right? So I think the catalyst to really get things going is the dollar collapsing. The evidence will be the fact that we're not getting more stocks making new lows and new highs. We're getting expansions in the new highs list, 63-day highs list, 126-day highs list, eventually the 52-week new highs list. But for now, baby steps first. Let's get that breath thrust in the 20-day highs list. And I think we're flirting with it. We're getting close.
Indeed, JC. And I think we're bumping up against our time here. But I got to say, your energy level, one person came in and said they love your energy, and so do I. So want to thank you so much for participating in our call and in our briefing, giving us a lot of food for thought. And I'm also glad that you put out there that my viewers here, or anyone that watches this later on our YouTube channel, they can contact you for slides or anything. So with that, we want to conclude our monthly CAPIS research briefing. We want to say a big yay, thanks, JC, if we can get our energy up as high as you. Our next briefing is tentatively scheduled for September 15th, which will feature the Markets Policy Partners tag team, my favorite dynamic duo of Brendan Walsh and John Fagan. On behalf of the CAPIS family and AllStarCharts and JC, thank you for watching. And everyone, have a great, great trading day. Take care, JC.
Thank you, John. Appreciate it.